All right, we're moving on to new topics in Chapter 5 and 6. In Chapter 5 and 6, we're trying to learn how to do accounting for merchandising operations. All right, so the first 4 chapters, for the most part, service revenue or the accounts that we use relates to a specific type of knowledge or skills that the company is providing to clients. For this chapter, merchandising operations, as well as the following chapter, Chapter 6, we're trying to learn how to do accounting for another type of business that provides goods to customer instead of providing a type of skill or knowledge. Okay, so these merchandising companies, we will have some of the new accounts to learn for this chapter. Specifically, inventory account is a new type of asset account that you will be dealing with a lot for this chapter and this following chapter. Okay, so inventory is a new asset account, and it has various different functions that we'll talk about some of the entries that will relate to this account a little bit later. So the first part of this chapter today I want to cover is the purchase side of inventory, purchase side of the entries. So this relates to not only the purchasing cost of inventory, but also possibly potential freight charges if the purchaser is the side in charge of paying the transportation cost. How do we journalize freight charges? How do we journalize the cases when there are discounts offered by the buyer, by the seller, and if our company is able to pay back the money within the discount period, what happens for this case? Also, returns and allowances. If the purchase items, the purchase goods is not satisfactory to your business, or in case that within the transportation process it got damaged, how do we deal with these cases in accounting? Okay, on Wednesday we'll be covering sales side of the entries. On Wednesday, and then after purchasing and sales entries are introduced, then again we do adjustments, closing entries, and then we do statements. Okay, so this chapter itself, we're moving on to another type of business, but really the accounting cycle, keep in mind, is the same. Okay, the accounting cycle introduced to you in Chapter 1 to 4. Remember, we start from the beginning balance of permanent accounts, and then we journalize new entries, summarize these entries, we post entries to ledger, we summarize them in financial statements. Remember the worksheet that we did before and after adjustments, and then we close the temporary accounts, and then of course at the end some of the companies may do post-trial balance, and then again we start from beginning balance again. So the general accounting cycle introduced to you in the first 4 chapters is still there. The only difference is that we're applying it to another type of business. Okay, earlier we're focusing on e-learning service type of business, but now we're moving on to merchandisers. But again, it starts from account balance. We do journal entries, post them to ledger, summarize them in worksheet, do financial statements, and also we do the closing entries. Okay, so everything you learned in the first 4 chapters still applies. It's just that we're adding in new accounts that relates to this type of operation activities. So this is a general operating cycle. We know what an accounting cycle is, but in terms of how the products flows into the business, how the products flows out to customer, this is the general operating cycle. Okay, in a simple form, we start from the first side of the entries, purchase inventory. Okay, so today you'll be introduced different cases under purchasing inventory. As I mentioned earlier, some of the freight charges, discounts, returns. How do we take care of those in the first side of the cycle? So after we get inventory, then following up, of course, we want to sell it to a company wants to sell the inventory to customer to generate the profit in between. So in the beginning, when you purchase something, you have the cost that you spend, the money that you spend, that you pay to wholesaler, pay to supplier for the goods. Then you immediately resell it to customer and generate the difference amount, the profit in between. Okay, so the inventory we're referring to in this chapter, we're referring to fully produced goods. Okay, we're not talking about manufacturing the goods here, not talking about the bits and pieces, how to actually produce to a final product. The inventory we're dealing with in this course throughout the entire semester, we're dealing with ready produced products, readily finished, and is ready for customer to purchase. Okay, and managerial accounting in another course, you'll be dealing with how to take care of the materials, how to take care of the labor costs. Those relate to the business that you actually produce and manufacture the goods. But this chapter, throughout this course, we'll be focusing on retail businesses. Basically like, for example, Walmart, ShopRite, Target. So all the grocery stores, the stores that you visit for the most part, they purchase finished goods from different companies and then they mark up a price, resell it to customer. For the most part, they don't produce or manufacture those products. Okay, they're there to purchase finished goods and resell it to customers at a specific local area. Okay, so after selling the inventory, then of course it's company either collects cash or accounts receivable. If it's accounts receivable, then later on, within a month or so, company will be collecting cash based on those. Okay, so then again, you have the cash. Company will purchase more inventory, market the price, sell it to customer, then get cash again. So this is the general operating cycle. Now, if we move on to the differences, specifically comparing the differences between merchandiser statements and the statements that we have seen in the first 4 chapters, the red highlighted accounts here are the new accounts. Okay, we have inventory that you will see under balance sheet. Again, this is the asset account. So just like other asset account, the normal balance falls on the debit side. Okay, so meaning whenever we purchase inventory, then amount times the cost that for each and every product altogether, purchases cost falls under the debit side. We increase inventory by debiting inventory account, just like a regular asset account. Okay, once again, inventory represents finished goods. Okay, not the material, not bits and pieces of a product, but it's actually a finished product here. So some of the companies may call it merchandise inventory, some companies may just call it inventory. So these 2 terms you will see in practice, both of them are used. For more popularly, usually inventory is a term used for most cases. Income statement, matching up with the inventory that we purchased. Later on, of course, we want to use this to generate profit, generate revenue. And this type of revenue is called sales revenue. Some companies call it directly just sales. Sales equals sales revenue. Okay, so this is a revenue account. Again, just like other revenue accounts, just like service revenue, interest revenue, any type of revenue account, the balance is on the credit side, normal balance. So when we sell the inventory based on a new market price, the retail price that we set, the inventory amount, the revenue amount will fall under the credit side. Okay, now by generating revenue, we're actually giving away the inventory that we purchased earlier. So we have an account here that matches with the inventory that we purchased earlier, but the account represents the effects of the inventory that has been sold to customer. This is what we call cost of goods sold. Okay, so cost of goods sold doesn't have an expense term in it, but really it is an expense account. So it follows the regular expense rule, debit increase. Okay, this term may be confusing a little bit since it doesn't have the expense term. Just remember that it's similar to the idea of having, earlier we mentioned supplies purchased earlier as an asset, and then when we use up, we call it supplies expense. Or in the chapter 3, we also mentioned prepaid insurance asset account or prepaid rent account. Then when we use up, it's called rent expense or insurance expense. Here for a merchandiser's company, inventory is an asset account that we purchased earlier, the goods, the cost of the goods that we purchased from wholesaler, from supplier. When we resell it to our target customer, it turns into cost of goods sold. Okay, so whatever amount that earlier was captured here, once we sell it to customer, it turns into cost of goods sold. This is an expense account when we sell it. Right, so there's 3 new accounts here on the purchase side of the entry. So on Wednesday, we'll be covering additional accounts for sales side. For purchasing side, we will be increasing inventory. And then when we sell it, of course, it increases sales revenue. Also affects cost of goods sold. Again, this is an expense account specifically just referring to inventory expense. Okay, we don't call it inventory expense, but we call it cost of goods sold. This only represents the used up inventory that we sell to customer. Okay, it doesn't represent any other type of asset. Only represents used up inventory that we sold out to customer. All right, so we take a look at actual statements. And we'll see that for service company on the left side, you should be pretty familiar with this. On the left side, we covered this in the first 4 chapters. On the right side, you'll see a new account inventory. So all the other ones typically are also there. Cash, accounts receivable, prepaid insurance, prepaid rent. So the only difference is that you see an additional asset account, which really is the majority of how the revenue comes from for merchandiser's business. It comes from this asset account. Because you use this, you resell it to customer to generate the majority part of your profit. In terms of income statement, you'll see cost of goods sold. Usually it's directly listed underneath sales revenue. So at the end of this chapter, you'll be introduced to another type of income statement. The general idea is still the same. Revenue minus expenses. It's just how merchandisers structure it is a little bit different. We call them multi-step income statement. Under multi-step income statement, cost of goods sold is the only expense account that we will be listing it up front, different from all the other expenses. So you will see cost of goods sold expense, again, it only relates to inventory account, will be listed right up front underneath sales revenue. So the focus here is that we want to know, based on the inventory that we sold out to customers, sales revenue, and the original cost of the inventory, cost of goods sold, what is the gross profit that we generated just based on these 2 accounts? Okay, so again, cost of goods sold will be a lot larger. The amount will be a lot larger than all the other operating expenses. Because remember, this is the inventory cost. This is the main method, the main approach how this company gets profit. So we want to know what is the gross profit first for this type of business, and then subtract all the relatively minor expenses, operating expenses. Okay, so there's a difference for income statement. There's a difference for balance sheet. Income statement is pretty different from the original service type of business that we covered earlier. Earlier is just grouping revenue, grouping expenses, and find net income. For income statement, at the end of this chapter on Wednesday, you'll be introduced to a multi-step income statement, which breaks down different types of expenses. So in this case, you'll find cost of goods sold expense listed first, then the other operating expenses below that. Okay, now in terms of inventory, how companies keep track of inventory cost, keep track of the flow of inventory after you purchase the goods and then when you sell it, how they manage inventory, the systems, there are 2 types. Okay, the one that we're focusing on in this course will be perpetual inventory system. If we have time at the end of the semester, we'll get back to periodic. But the one that's most used in practice and the ones that we will focus more on because it's more important since it mirrors nowadays practice is this perpetual inventory system. Okay, so what this means is that because nowadays inventory systems, information technology is more prevalent than the early years. So oftentimes the company together with the optical scanning registers will be able to help the company immediately, continuously track the inflow and outflow of inventory. So for the stores that you visit before, if you've seen when you purchase some items, when you go to the cashier, when you check out the stuff, you see a barcode on the products and the clerk will be scanning the barcode. Those companies all use this perpetual inventory system. Okay, so the barcodes are there to keep track of inventory flow. Whenever the barcodes are being ringed at the registers, then immediately the inventory level will be affected. So if an item is being sold out to customer, inventory level will go down for that product. Okay, and then when it reaches down to a certain level, of course this will also trigger an automatic purchase order if it reaches the replenish level for that type of inventory. Okay, so inflow and outflow, especially outflow here, barcodes are there to capture the transaction of selling items to customer. So the inventory system under the T accounts, the journal entries will be immediately affected. This is what we call perpetual inventory system. It constantly tracks the inventory level, the inventory cost, and also will be able to replenish inventory immediately when it reaches a low level. Okay, so the advantage for this system is that whenever you look at the inventory records online, it will represent the current status of the inventory account. You see the current amount that's there in the warehouse. You have the current value of the inventory in total based on the amount times the original cost. In Chapter 6, we'll be going over inventory costing. There's also two different methods to keep track of the inventory cost. But generally speaking, if a company constantly and continuously tracks the inventory level, then it falls under a perpetual inventory system. Usually they do have computerized systems to keep track of this. So for the most part, public traded companies or the large brand stores that you visit, they all use perpetual inventory system. In case you forgot what a barcode is, this is what it looks like. So when you ring the items, when you purchase the items, you want to take it back home. Before that, you go through the registers. They will be ringing this barcode, and immediately, again, corporation's inventory level will be affected. So this is used to record sales, record inventory expense, which we call cost of goods sold, and at the same time, update inventory asset accounts. So all of these accounts will be affected at the same time. Okay, you'll have a better idea when we go into the journal transactions. So here, the purchase side, of course, it only affects inventory. And when we sell the product, at the same time, corporation's perspective, they generate sales revenue, and then immediately inventory will be reduced, cost of goods sold expense will incur. So representing that the item is being shipped out or being removed by the customer from the store or from the warehouse, and immediately cost of goods sold expense will be accumulated. So as opposed to this idea of continuously tracking inventory, as opposed to this, another type of business, typically small local stores, they don't have as much budget to purchase this computerized system. If you visit a store, they use a regular calculator to keep track of sales revenue and tell you the purchase price for the items that you have on hand with you that you wanted to check out. Typically, these are the companies, if they don't have barcodes with it attached to their products, they're using periodic inventory system. Okay, so meaning that they don't actually keep track of the inventory level after each and every transaction that happens. They could wait till the end of the day to match up, actually count the inventory value in their store, then match with the accounting book that they had, the transactions that has been recorded. Okay, so they double check this inventory level at a certain period of time. It could be a day, depends on the local store. It could be a few days, could be a day, to keep track of the inventory level, and then update it all together at the same time. So this is less frequent nowadays since the technology is more prevalent now. So usually only for small businesses, if their budget do not allow them to have a system like this, where they don't find it as efficient, it's useful for their type of business, for restaurants, for retail stores, small local stores, then they will still be using periodic inventory system. Okay, but again, our focus, all the transactions, the journal entries covered in today's course and on Wednesday, we're focusing on perpetual inventory system. Okay, so as of now, you just need to know there are two types, and we'll be focusing more on the perpetual one. And periodic, how they journalize the entries is a little different. Okay, the general idea is the same, but the details on journal entries, debit, credit, and the accounts is a little different from perpetual. All right, let's move on to journal entry. So this is a general background of merchandisers companies, the different types of inventory systems. And again, we're focusing on perpetual system. How do we take care of the events that relates to purchase inventory? So again, this inventory account is a current asset account, debit increase. And whenever corporations purchase batches of inventory from wholesaler, from their supplier, and of course, there will be a purchase invoice that contains all the details. So this is a source document. Remember that each and every journal entry happens, but there's definitely either a bank deposit slip or purchase invoice, receipts that backs up that transaction. Okay, so this invoice submitted by the seller side captures of course, the seller's company name, purchaser. If I'm the purchaser, my corporation's title will be there on the invoice as well. The date of the purchase, this is very important because later on when we talk about discounts, we'll need to determine whether our corporation is paying the money on time and whether it's even earlier, whether we're able to get a discount offered by the buyer. Okay, so date is very important. Credit terms, this relates to, later on I'll introduce to you the discount period and the discount specific percentage. That's what the credit term refers to. Okay, discount period, discount percentages, and overall, if we do not get the discount, what is the time frame that we need to pay back the money in full? Okay, total amount due and the specific due date, which goes back to credit terms again. Okay, so inventory account would be affected by several items. So this is a very special account that captures not only the purchase cost of inventory, but later on, whenever there's freight charges, it also affects the inventory account. Okay, if we receive discounts, it also affects inventory account. When we return items, or if we don't actually return it, but we are just granted by the buyer a certain level of refund, this also affects inventory account. Okay, so in accounting, this account is very special in terms of what the transaction affects it. We don't have separate accounts for freight charges from the purchase side or separate discounts or returns allowances if we're journalizing entries in the perspective that we are the purchaser. And anything related to these purchase transactions falls under inventory account. Okay, so this account is not just affected by the original batch of the inventory, the cost of that inventory, but also all the other cases that happens later on. Okay, let's take a look at the first entry here. So the very simple one here just represents purchase inventory and the cost of the inventory. Okay, so in this case here, are we paying the money immediately if you're the company? What does this show here? Accounts payable. So this inventory amount will not be deducting cash immediately, but this is a liability. So again, liability account, whenever it increases, is on the credit side, remember? So accounts payable liability, typically, again, we will be paying off this money within a month or so. And then later on, we'll have to match with the credit term to see whether the time point that we're paying money falls under the discount period or not. Okay, if there's discount period, then we may not be paying in full $700. We probably could be paying a dollar amount less than this. Depends on the percentages discount that the buyer offers us. Okay, but this is the first entry. On June 3rd, if a company purchases a batch of inventory that's worth $700 from the supplier, from wholesaler, then this will be the journal entry to make. Debit inventory, credit accounts payable. Okay, if we purchased immediately by cash, then of course the credit term will not matter, and just reduce cash $700. Okay, the discount period, any credit terms, usually is offered from the buyer to the purchaser to encourage them to pay the money up front as early as possible. Okay, so this is the first entry. Now purchase discounts, just state the first entry here. We have inventory, accounts payable, $700, June 3rd. So this credit term here, 210 net 30, represents that the full amount is due within a month, within 30 days. However, if you pay within 10 days, you'll be getting 2% discounts, meaning you're getting 2% off from the original $700. Okay, so the full amount is the part after the comma, net 30. That means anyhow, regardless of when you pay, you have to pay within a month. Okay, this is the accounts payable's due date after the comma. Before the comma represents 210 represents that if you pay within 10 days, so the original transactions was June 13. If you pay was June 3rd, if you pay within a day between June 3rd to June 13th, then you'll be getting 2% off. Okay, you're only paying 98% of the full amount. That's what it represents here. Okay, so there are different types of credit terms. Companies may also decide not to give out any discounts at all. Could be just net 30, okay, or net 40. The slash 30 means the exact days. Okay, if it's slash 40, that means you have to pay within 40 days. Okay, slash 45, pay within 45 days. If you see something before the net 30, then that means there is a discount offered by the buyer to encourage you to pay the money back earlier. Okay, so then the first digit there will represent discounts. Okay, it represents 2% discounts if you pay 10 days. It can also be 3/15, for example. 3/15 represents that if you pay within 15 days, you're getting 3% off. Okay, so the first digit represents the percentage of discount. Second represents the number of days that is the discount period. And then the remaining after comma is the full amount due date, so within 30 days. Right. EOM is another way to represent credit term. It's less used, but it can also happen on some of the purchase invoice. You may see EOM, it represents end of month. Okay, EOM represents end of month. So what this means is that if this transaction happened June 3rd, then this transaction will be due, the accounts payable is due June 30th. Okay, if it's July 3rd, then that will be July 31st, the very last day of the month. Okay, EOM represents end of month. And again, in this case, there won't be any discounts offered. You just have to pay within a month. Choose a day as long as it's within the month. Okay, again, these are the credit terms that is offered for the case that companies purchase something and they do not pay immediately by cash. They have accounts payable there in the transaction. In this case, oftentimes buyer will set a credit term, sometimes encourage companies to pay back the money in advance. So they would be setting a discount period, setting a discount percentage to encourage buyer to pay off the money. Otherwise, they would set a full due date. It could either be a whole month, 40 days, 45 days, depends on the business. They can also set it as the very last day of this month, end of month. Then regardless of when the transaction happens, just figure out what month it happened, and the very last day of that month will be the due date for this. Okay, so you have this in mind. Let's say that this transaction, suppose that it doesn't have a discount period. We had increased inventory earlier, we purchased from the supplier, we purchased it on account, accounts payable. If it doesn't have a discount period, let's say for these two cases, we just need to pay it off on a certain date within a month, then the transaction, when we pay it off, just like a regular on-account payment, we reduce accounts payable, pay by cash. Okay, in the case that there's no discount, this will be it's actually a pretty simple transaction. We just purchase asset earlier, like what we covered in the first 4 chapters, any type of asset. Then you pay off the money, the on-account amount, $700, by reducing accounts payable, pay by cash. Okay, so this is the case without any discounts. If we do have a discount offer from purchaser, from the buyer, and from the seller, and we actually do decide to pay within the discount period, then this will be a transaction that would happen. And we will have 3 accounts affected, not just accounts payable and cash, but also inventory account. Okay, so this case we're talking about this discount case here. Okay, remember, inventory account captures the effect of different cases. This will be the first case that, other than purchase inventory, discounts will affect inventory value. Okay, what this means is that this is a transaction that I just told you here. Without the discount, we'll simply be reversing liability, paying the full amount, $700 in cash. If we do accept the discount, and let's say it's 3% discount within the discount period, and in this case, again, accounts payable will be reduced just as a regular case will reduce liability. But the right side, cash, will not be reducing $700 because we got the discount, right? We pay within the discount period. We're only paying cash $679. Okay, so the remaining $21 that relates to that 3% discount will be captured under inventory. Okay, so meaning that in the inventory account, you would see the left side earlier, we have $700, June 3rd. And then now a few days later, when it reaches June 15th, we have $21 of discount recorded here. Okay, what we're trying to do here is recognize the inventory discount as reducing inventory's cost to match up with the cash that we're actually paying for this batch of inventory. Okay, so it's not saying that we're selling inventory or any pieces of the inventory went bad or disappeared. We're just trying to match up that the inventory cost, the batch of inventory that we purchased earlier, originally worth $700, but we received a discount that we're actually just paying cash $679 for this batch. So we reduce inventory costs at the same time to match up with the cash that we are actually paying for it. Okay, again, so earlier we purchased inventory $700. This is the transaction that happens and you will see on the invoice. But then later when you pay the liability, we're not reducing our cash altogether by $700, but only 97% of it. The other 3% goes into inventory account. Reduce this inventory. Think of it as reducing inventory's cost because we really didn't use up cash $700. We only used $679. So after this transaction, at the same time, inventory will represent 700 and then minus 21, also 679. And we're trying to match up inventory's cost with the cash that we're actually paying for it. Okay, so this is the first case. If we have purchase entry by purchase inventory on account and we pay within a discount period, then we will see discount reduce. The amount that we didn't actually pay by cash will be reducing the inventory value as well at the same time. Okay, if not, then it will just be this transaction and there will not be $21 here. You will still see $700 because we're actually paying $700 for this inventory purchase transaction. All right, so this is a credit term that encourages companies to pay earlier and they get 3% off. In case there's 4% off or 5% off, you'll just be switching the percentages here and you'll be paying 95% of the original amount or let's say 96% of the original amount, but the accounts are the same. Okay, just make sure you capture the right amount of cash after discount. Capture the right amount and not the entire full amount, 700. Okay, it'll be after taking off the discount. Now some other cases here besides discounts may happen. Other cases, let's say I purchase a batch of inventory. By the time I receive it from UPS or other FedEx transportation companies, by the time I receive it, I open it up and there's already damaged goods in it. So in this case, again, it depends on how serious the damage is. Sometimes the buyer, the seller may want me to ship back the goods to them if they think that they could fix it, resell it to other customer. Other cases, let's say it's perishable items and it's completely broken. Okay, so in that case, we may likely hold on to the goods, but the seller will be giving us a refund, an allowance. Okay, so there are two cases here, but shares the exact same entry. In purchase side, we don't separate the case of whether or not we actually give back the inventory to the seller. If it's just an allowance, that's fine. If we actually return the goods, both cases here we share the same entry to capture the effect. Okay, we have to recognize that in reality there could be two different cases. It could be actually shipping back the goods, either because it's really just has a minor damage or simply because there was an error that you got the wrong product, not as what you ordered. Okay, so purchase return is a case. Purchase allowance is the case that without returning the goods, but both cases you will have a reduced amount of liability. Okay, meaning that earlier you purchased inventory $700, you thought this is the value of the goods that you will have in a few days. But then when you receive it, let's say the total value that you can actually use to resell to customer only worth $600. The 100 here either damaged or just wrong goods, not the one that you ordered. This part here will be reduced and your accounts payable will also be reduced. Okay, so this is what the allowance means. You will no longer be paying back the seller $700 in full because a part of the goods either is damaged or it's not what you ordered. Okay, but these two cases, in terms of journal entry, we don't differentiate them. But you have to know that in reality there are two different cases. In terms of journal entries, both of them will be captured under inventory. Okay, once again, for purchase returns, purchase allowances, both cases the accounts payable will be reduced. Reduced by the amount of the goods that we either ship back to the seller or we keep hold to it, but at the same time, the amount we're not able to resell to other customer. So the seller typically will also reduce the amount of the value of those goods. Okay, so for both cases, shares this exact same entry here. If the amount of the goods that's no longer useful, we cannot sell to our customer, is worth around $100, then we will be reducing inventory by 100 and reducing accounts payable. Okay, so accounts payable on the debit side means that the liability originally increased on the credit side $700, but now we reduce it by 100. Later on, we just need to pay the seller $600. Okay, the right side, $100, could represent actually shipping back the $100 worth of inventory to the seller or keep hold to the ones that are no longer useful to our customer. But we get a refund from the seller. Okay, so for both cases, we use the same entry. So far what we have here is, if we look at inventory account, the debit side we have $700 purchase entry of inventory. Right side, if we do an inspection of the $700 worth of goods and we realize there's $100 that's not what we ordered or it's no longer useful for us, we can't resell it to our customer, we reduce this amount. And then usually this will come first because usually when the company gets the products, they will do a quick inspection and make sure that this is what they ordered, make sure this is ready for sale. So usually this is a case that will come first, purchase returns and allowances, if any, if this case actually happens. Then later on they will be paying the money. Okay, so if this case happens, we'll have to reduce the 100 from 700. $600 worth of goods, then you apply any discount. Okay, I mentioned discount earlier first, but in reality, after inspecting the goods, if there's returns and allowances, you usually reduce that first because typically that happens just a day or two after the company receives the goods. Okay, then a few days later, within the discount period, likely company will be paying off the inventory amount. Then you apply the remaining value of the inventory to the discount. Okay, last case here, transportation costs. There's different types of transportation terms, FOB terms. The FOB stands for free on board. Basically, just the two different types of FOB shipping point, FOB destination, would determine which party pays the freight charge. Okay, this will be decided up front, but when you look at the invoice, if you see FOB shipping point, this usually is the most common case, and this represents that purchaser. If my company purchases the inventory, purchaser is the side that pays the freight charge. If my company purchases inventory, the shipping point, the ship term is FOB shipping point, then purchaser, my company, will be paying the freight cost. Okay? So at the same time, it also represents that once the goods are shipped out from the seller, throughout the entire transportation process, the goods belong to my company. Okay, so the FOB term determines which party is paying the freight charge, also determines within the transportation process which party is the one that is entitled for the goods. So if I'm the company purchasing the goods, in my perspective, this will be a freight charge for me to get the inventory into my warehouse. There's another way to represent this also, we call a freight in charge. Okay, if you see FOB shipping point, freight in charge, that represents really the same thing. The freight charges, purchaser is the side that is paying it, and we're paying it because we're getting items into our warehouse. So we can call it freight in. Freight in represents that purchaser is paying the freight charge. So in this case here, this entry represents the $60 of freight charges. And let's say we're paying it immediately to UPS company or FedEx, for example. Then this will be the transaction occurred here. So freight charges you see here, we're reducing the cash, again, because this is additional expense. But this we represented under also inventory account. Okay, freight in charge usually comes at the end, and it's not applied to any of the goods that we readily returned. Okay, so freight in charges usually is additional to separate it from all the other transactions that we covered earlier. You will either be immediately, the problem will tell you immediately either the freight charge is $100 or $120, and you're dealing with different companies too, because the inventory you're purchasing it from the seller, but the freight charges you're really dealing with transportation company. Okay, so this cash is not paid to the seller, this cash is paid to transportation companies. Okay, so we think of freight charge as like a package that you purchase. This batch of inventory comes along with this batch of inventory's value. So just like how you and me, we may be purchasing things on Amazon. Right? If you purchase, let's say, $1,000 worth of something, of goods on Amazon, and you are the purchaser, you're also the party paying the freight charges, that will be added additional to the $1,000 worth of product that you just purchased. Right, so that will be add on to that 1,000. You may have additional $50 of freight charges, let's say, of the based on the goods amount that will be added to your purchase transaction. So in the perspective of a corporation, it's the same. It's very similar to our personal purchase transactions. You have a batch of inventory that worth $700. The less complicated case would be, let's say it's all good. You don't have to return any. And let's say that you're not offered a discount period from the seller, then it will just be $700 plus any freight charges that happen if the agreement is FOB shipping point. And whoever is purchasing the product is entitled to pay the freight charge. So this is the most complicated case that we just talked about. If we purchase the item, a batch of goods, we realize a part of it is not useful for us, we can't resell it, then we have to immediately reduce this amount. Of course, notify the seller. Okay, then after this process, you still have $600 worth of inventory, and if your company is willing to pay within the discount period, then you get a few dollars off discount. Okay, but at the same time, freight charges, you will need to, once you got the goods, you also need to pay this amount to transportation company. So in terms of the title of the goods, again, you have seller, there's purchaser. If I'm the company purchasing the items, the title of the goods transfers at the time point when the goods are being shipped to me. So throughout the process, the goods belongs to my company. And after I receive it, purchaser pays the freight charges. This is the transaction that happens. Right now, another real-world case would be that if the seller has an agreement with UPS, with FedEx, that they sign a contract with them, so when they sell their products to my company, at the same time, I just directly deal with these freight charges with the seller. So this is what this slide is trying to represent. Instead of me dealing with the transportation companies, oftentimes seller may have a contract with specific transportation companies. So customer just need to deal with seller with the $700 of inventory also together with the $60 of freight charge here. Okay, so this is another example that, let's say I purchase inventory from a company that worth $5,000. That's the value of the goods. And $400 is the freight charge here. Okay, so in this case, if the seller has that contract, I just directly pay the freight charge to the seller, and then the seller will deal with UPS or FedEx company. So in this case, inventory amount altogether will be $5,400 together with freight charge. And of course, if I'm not paying the money immediately, then it will be accounts payable. Okay, so for this case here, later on when we pay the money back to the seller, when we reduce the liability, it will look like this. We would debit accounts payable, and let's say that we also pay within the discount period, since it's only 5 days differences here. Within the discount period, there's 3% offered. 3/15, net 30. So I pay within 30 days. If within 15 days I get 3% off, this 3% only applies to the $5,000 of inventory, not the whole $5,400. Okay, once again, because that $400 goes to another company, not the seller, goes to transportation companies. So when discounts is applied here, it only applies to $500, $5,000, the inventory's value. Okay, so this second transaction here represents that we're paying off inventory's cost by reducing $5,400 on the left side accounts payable. On the right side here, since we're paying within the discount period, we're only paying $5,000 and 97% of $5,000. Then the 97% of $5,000 plus freight charges will be the total amount that you're paying to the seller. Okay, again, this slide here shows the case that if I'm the company purchasing items from a seller, $5,000 worth of inventory, and I'm not dealing with FedEx or UPS separately with that $400 worth of freight charge, the seller paid it for me in advance. So I'm just now paying the $5,000 plus the freight charge $400 together to the seller as a package. But when it comes to discount, when we pay it off, we're not applying this 3% discount to freight charge, because freight charge is the cost that occurs, and the seller dealt with UPS or FedEx before. They already paid the $400 in advance. So the 3% really only represents the discounts off from the original $5,000 of inventory. Okay, we cannot apply the discounts to freight charges because that revenue belongs to another company. Okay, just to summarize it all, I forgot there's FOB destination. There's another shipping point. Another one that is less used is that the seller is the party that is in charge of freight charge. Okay, so this case here, purchaser does not record anything. In this case, if the purchase invoice states that there's FOB destination is the credit term, and if I'm the company that purchased items, I do not have to record anything. But for the seller, this will be the transaction for the seller. The seller will incur a delivery expense based on this batch of inventory that they're selling to customer. And again, reduced cash. This cash is paid to UPS or FedEx, okay, transportation companies. So this is called FOB destination, meaning the goods, the title of the goods do not transfer to purchaser until the goods actually arrive at the purchaser's company. So throughout the process, the goods belong to the seller. This is the opposite case compared to FOB shipping point. The FOB shipping point purchaser is the one paying the freight charge and title of the goods throughout the entire transition process. FOB destination is the opposite to that. So seller will be paying the freight charge. Seller incurs this transaction. Purchaser records nothing. Seller is entitled for the goods until the goods arrive at the buyer's company. And we'll be going over this transaction again when it gets to sales side of the entries. Here you just have to know that it's different from FOB shipping point. So there are two types of freight charge terms. Okay, going back to this chart again, it's goods is sold out from seller to buyer. Title of the goods transfers to buyer when the goods arrive at the buyer's company. This is the seller's book transaction. It's the same transactions that I showed earlier. And the purchaser do not incur any cost, do not record anything. Okay, so this is a less used case for FOB destination. Shipping point is more commonly used. Okay, we have just went over a lot of different types of transactions. So just to summarize them up in terms of how it relates to the inventory account. First thing that happens always, for all the remaining cases, all relates to the first transaction, purchase inventory. So you have a transaction that looks something like this. You debit inventory, credit accounts payable. And then because you credit accounts payable, you have liability to the seller. Seller typically may encourage you to pay the money off as early as possible. So you would see something like 2% on net a certain days. So the full amount is due within, let's say, 30 days. But then you get a 2% off if you pay earlier within 10 days. Okay, but before the discount is applied, of course, once the goods arrive at your company, you'll be doing an inspection of the goods, making sure that this is what you ordered, making sure everything is ready for you to resell to your target customer. If that's not the case, then the portion of the goods that is no longer useful will be reduced. It will either be shipped back to the seller or you'll be getting a refund from the seller based on it. So either it's damaged or it's not the goods that you actually ordered. Okay, so in that case, you'll be reducing that first, reducing liability as well. So the value of the inventory in the case that we talked about earlier, really only worth $600. And at the same time, you only owe the seller also $600. This will be the base for you to apply any discounts. Okay, so you got a discount period, you pay within the discount period, you get 2% off, then that will be the base to apply the 2%. Okay, for any discounts will be applied to after you return the goods, the goods that are no longer useful for your company. Okay, in terms of freight in charge, if the agreement is FOB shipping point, purchaser is paying the good, freight charges. The freight charge will be added to this whole batch of inventory cost. Okay, freight charges will be an additional cost that you either directly deal with the companies, transportation companies, or if the seller paid it for you, then you'll be paying this off to the seller. But again, freight charges do not apply any discounts. So you see that I list purchase discounts first, and then you consider freight in charge. Okay, so don't mix it in before you do the discounts. It always comes after that. Okay, let's do a quick exercise just to close this part of the lecture up. Here you're given an amount of inventory that's worth $185,800. These are the toys that a company purchased from another supplier. The date of this transaction is July 8th. Credit terms is 2/10 net 30. Again, if your company is a purchaser, you need to pay within 30 days. Within 10 days, you get 2% off. Now, some of the goods, they realize that is damaged in shipment, so they request for a refund and allowance. They returned $18,530 worth of inventory. Okay, so for this company here, this transaction, the return happened 4 days later. Now, here are two cases, two questions for you. If this company pay after the discount period, what would be the amount that they pay after the discount period? And if they pay within the discount period, both cases using the same data here, what would be the amount here? Okay, so today let's just deal with the amount, not the journal entry. Just think about what is the amount that you're paying after discount period, or if your company is able to pay within discount period, what would be the dollar amount? This. I just passed around a handout for some of the transactions that we talked about today on the left side, and then also practice questions. So any of you that didn't get a copy? The handout is also on Blackboard, so in case you lose it, you can still download it from Blackboard under course documents. So on Wednesday, we'll talk about sales entries, so you can see the differences by comparing these two columns. All right, for this problem here, it doesn't talk about freight charges. We can just leave that from this problem. It only talks about the original cost of the inventory, talks about discount period, and also the value of the goods that is not useful for your company after receiving it. So you have the inventory in the left side. There will be a transaction that debits inventory, credit accounts payable, $185,800. After inspecting the inventory, the goods are not useful, and altogether the ones that are not useful being shipped back is worth $18,530. Okay, so going back to that inventory account, remember left side increase when we purchase inventory. Right side will decrease whenever there's discounts or returns. Okay, so the first question here, if we do not pay within discount period, then you don't have to worry about discount. There's only these two numbers, really. Because the first part, you have purchase amount, and then you subtract purchase returns. All together, later, your company will be paying cash $167,270, okay, without the discount. So what happens if they do pay within discount period? How do we calculate the amount? Mm-hmm. Times 0.02 will be the discount. And then, so the amount that your company is actually paying back to the seller would be after subtracting that 2% of discount, right? Exactly. So you have the returns that you already realize that this part of the goods is no longer useful. Subtract that first. Regardless of whether you pay within the discount period or not, usually this inspection will come first. Because you reduce that amount first and use this amount that is useful for your company, then you apply the discount, 2%. So the 2% discount will be $3,345. This is the amount that you do not have to pay to the seller. So you got this 2% off. You're just paying 98% of the full amount here, which would be worth $163,925. All right, so this is just a dollar amount, but today when you go back, try to think about transactions, how you would apply this to the transactions of purchase, transactions of purchase returns. So today we don't have enough time to go over those, so I'll be going over this with you on Wednesday. Okay, but here is just the cash amount that you're paying with the discount period or after the discount period, the differences. Okay, I'm going to skip through a few slides and let's get to midterm. A study guide I posted on Blackboard already. Okay, next week, next Monday midterm, there will be a mixture of multiple choice questions, short problems. The short problems I'm referring to problems similar to homework problems. So it will not be as lengthy because we only have an hour 20 minutes. So I'll not be asking you to do a full set of statements, but you have to know the linkages between statements. So for example, if I give you a statement and ask you to calculate a partial statement, ask you to calculate net income, are you able to do so? Or I give you a partial retained earnings statement, ask you to calculate the end balance of retained earnings. Based on the data I give you, are you able to do so? Okay, so I will not ask you to do a full set of statements, but you have to know the idea if I present to you a few statements. Or I may give you journal entries. So in some of the situations, I may give you ABC situations. How would you be able to journalize them? What are the accounts that you use? So the two accounts, the values, the dates. Okay, so just like similar to the problems that I give you on homework. Journal entries, account balances, relationship between statements. Multiple choice questions, it could be a mix of calculation questions, also concepts. Okay, since we're on the first 4 chapters, there are a lot of the things that really is just the grounding, the background, the theory of it. So it could be some questions asking you the terminology definition in multiple choice questions. Okay, I will not be giving you open-ended essay questions. So for short problems, there will be calculations or account balances or ratios, understanding what it means. Remember in chapter 4, there's 2 ratios. You have to understand how to evaluate business based on it. You have a question? Usually I give about 2 sets, and each set could be having requirements 2 to 3, most likely. Usually it would not exceed more than 3 sets of problems. Okay, so that depends. Short problems I haven't decided yet. So it could be about 2 problems. So altogether it only accounts for like 20% of the grade. Okay, so you have majority of the questions multiple choice, probably give you a situation, but only narrow down on asking you a specific type of account or a specific type of debit credit. Okay. Now in terms of each and every chapter's focus, some of the things that I did not list here on the bullet points, for example, in the first chapter related to ethical standards, or some of the organizations that I did not list here, you don't have to worry too much about it. Okay, the organizations that I list as important, I already stated it here, like FASB, GAAP. Okay, or the accounting profession, the salary, the job opportunities, you don't have to memorize any of those. Okay, the first chapter really, you need to know what is the accounts, what is the corporation characteristics, other types of organizations, for example, like partnership or proprietorship. You don't have to memorize too much of that. Okay, I will focus on the bullet points that I listed here. So make sure when you go over the study, start from reading the chapter, definitely. Okay, do not skip the chapter. Do not just review slides. Slides is just there to support, but it doesn't have the full information. Okay, make sure to go over some of the problem sets in the chapter as well. Those are very similar to the homework that I gave you. Okay, definitely read chapters in detail. Accounting equation, definitely need to know what that means and how it relates to statement. Remember, balance sheet mirrors the accounting equation. Right, second chapter and third, fourth really is the main focus of the exam. Second, third, and fourth. Okay, because there's a heavy amount of accounts, number of accounts introduced. You need to know each and every account's debit credit rule. The general accounting process, where do we start? What is the middle process here? Journalizing, posting to ledger, trial balance. Okay, whenever each and every transaction happens, how it fits into this accounting process. Okay, at the end, after posting to T accounts, how do you get final balance? So after final balance in chapter 3, we do 5 different categories of adjustments. Those 5 adjustments are important too. Okay, make really sure to review adjustments. You'll definitely see questions on those. All right, chapter 4, worksheets. You just have to know the definition, what a worksheet, the purpose of it. I will not ask you to do an entire set because it also takes hours. But if I give you one, you need to know, for example, income statement column. What does it mean? Remember income statement column in the last part, you will see net income or net loss. So if they give you a worksheet, you have to know what it represents, the information there. Closing entries, also important to know. You have to know the purpose of this. Remember, you want to zero out accounts, temporary accounts, transfer amount to retained earnings, update retained earnings. You have to know the 4 steps of closing entries. Okay? So the parts that I focused today in class that I pointed out specifically, you'll definitely see questions on it. Classification of assets, this is fairly simple compared to other points. You just have to know there's current asset and long-term asset. Definition is that used 1 year, within a 1-year period, if you use it up, then it's current asset. Otherwise, if you can use in the business for a long term, it's long term. Liability, similar. If you pay it off within a year, then it's short-term liability. Otherwise, it's long-term. Current ratio and debt ratio, you have to know how to calculate this. Okay, after calculating, how to interpret the results. So what is the rule of thumb for current ratio? 1.5 is considered good. If it's somewhere in between, it's okay. But if it's lower than 1, it's considered risky. Okay? Rule of thumb for debt ratio. Debt ratio, remember, we're trying to understand the relationship between total debts, total assets. So if the total debt reaches more than 0.6, reaches 0.8, somewhere even above that, then it's considered very risky. Okay, 0.8 is sort of like the rule of thumb. Below 0.6 is considered fairly well. Okay, so these bullet points, make sure to cross them out as you go over your studies. And for multiple choice questions, I would suggest you to review each and every chapter's quick check section. Okay, in the chapter, in the book, there's 10 questions after each and every chapter. Then you have answers in the back of each and every chapter. Okay, make sure to review those first. Those are elementary questions. Then you can also go over the My Accounting Lab for test quizzes, study plan questions. You have plenty of multiple choice questions there. That will help you and guide you through some of the points that are critical. Okay, that you will see some of the questions there exactly on exams. Okay, make sure to review those. All right, so I was going to go over practice questions. You want to go over this with me? Or do you want me to go over this with you, I should say? All right, practice questions also is important to review. I just passed it around your own, so make sure to pick yours. Accounting information system does all of the above. Okay, accounting measures business activities, journalizing and posting them to ledger, communicates the results to decision makers, and then, of course, we process these statements to outside users. Okay, these practice questions points out the key point of each and every chapter that I would like you to know. So you also have to review these. Characteristics that best describes a corporation. So which one is this? Limited liability stockholders. Very good. This is very special. It's different from other organizations. So by purchasing stock, investors, they only own a certain portion of the ownership for the corporation. They also only have limited liability to it. They're not in charge, not responsible for the majority of the debt that the business has. Okay, FOSS's liability should be fairly easy for you right now. Accounting equation, assets minus equity will give you liability. Okay, so this is C. It's from chapter 1. Where e-learning service company received a promise from their customer. 3 weeks later, they'll be paying this service. In the company perspective, they have this transaction, and this will affect which account? Accounts receivable. They provide a service, and they haven't collected the money. Exactly. So the account decreases with a credit. Decreases with a credit. Well, it got to be asset, right? Asset increases with a debit, so decreases with a credit. Accounts payable liability increases with a credit. Common stock equity increases with a credit. Revenue also increases with credit. Okay, so assets decreases with credit. Which of the following account is an asset account? Prepaid expenses, very good. Expense revenue, equity account, accounts payable, liability account. Now, the sequence of summarizing accounting process. The accounting process. Which one mirrors it? D. We journalize transaction as activities happens, post them to accounts, prepare trial balance. Of course, this continues later to completing the worksheet, doing financial statements, close the entries, and then you have final balance, and then you start from beginning balance again, journalize the transactions. Okay, this is the process in chapter 3, but later on we expand it in chapter 4. Okay, business buys $500 supplies on account, so which account will be credited? Accounts payable. So the debit side will be supplies. Okay, anything on account, if you're the side purchasing, then it will be accounts payable. If you're the side receiving the benefits, then it will be an accounts receivable for your company. Revenue recognition principle states what? Now for this, some of you got wrong, so which one is this? We record revenue after you actually earn it, and the earning it, this earned term definition is that you provided the goods and services. Even though you have not collected cash, doesn't matter. It will be under sales revenue, accounts receivable. Okay, the best ideal case is you collect cash immediately, then you'll be debiting cash. But in both cases, you have sales revenue credited. Okay, what is the purpose of adjustments? Updating accounts at the end of the period, exactly. Okay, adjustments to 5 categories: prepaid expense, accrued expense, unearned revenue, accrued revenues, and also depreciation. All of these adjustments happens at the end. There's only a few entries. Okay, if this company prepay your business for a package of 6 training sessions, which account is affected in my record here? I'm sorry, if your company prepay other company. So in this case, for your company, you prepay something in cash in advance, this will directly be prepaid expense. Okay, if your company is the party prepaying money to other people, then this is prepaid expense. If customer prepay you in advance for a service, then it will be unearned revenue. Okay, so this is the case that you are the company prepaying others, then it will be prepaid expense. Accounting data flow, the relationship between statements. Which one is correct here? It will be both A and B, right? Statements, we always prepare from income statement to statement of retained earnings, and then retained earnings to balance sheets. This is always the flow, okay? Because income statement is more narrow, it goes to retained earnings, and then balance sheet is the most comprehensive one. In the column in the worksheet that is not adjusted, what do we call that? Not adjusted would be trial balance, right? After adjustment will be adjusted trial balance. Okay, last one here, what do closing entries accomplish? It accomplishes A, but it also accomplishes B, and it also accomplishes C. Okay, so it would be all of the above. The process of zeroing out these temporary accounts, we transfer them to retained earnings for the purpose of bringing up retained earnings balance. Retained earnings, remember, it is an earnings accumulated account, just by its name. It keeps all the earnings. By doing this closing transaction, closing entry process, we'll be transferring amount to retained earnings.